So here, basically, you are an importer. First, you are an importer. Okay. So you buying a call option. So there are two legs. You are playing a strategy. You are mildly bullish on dollar. Okay. You don't expect the dollar to go run away from say current level of 83. It will not go past 84. That is your view. Okay. And that view can be only when you go through a technical analysis route. Okay. Fine. Suppose your view is that it will not go beyond 84. Okay. So you actually play a strategy. Buy a call option. Okay. The same thing. 100 is the size, 100 contracts. $1 lakh is your money which is at stake. So today you choose 83 rupees 25 paisa, the strike price, and the premium is same 23. So I have, what I have done? I put the formulas coming from the call option strike price. These are strike prices. Here I've chosen this and this. So first I'm buying a call option at 23. So then I go to bull call spread, and here 83 has a linkage from the earlier slide, and the premium will also have a linkage from there. Okay, fine. Now, when you buy a call option, who has the right to exercise? The call buyer. So I have this thing. When you write a call, who has the right to exercise? Again, the call buyer, not me. So I have two legs where one I have the right, and in other case the other one has the right. Okay. Yeah, I have to honor it. Fine. So just listen to me. There are a couple of things which I want to say before we enter this. Now, the call buyer has a right to exercise. Call writer doesn't have an exercise right, isn't it? If I exercise, if I just walk out, he's going to pocket the premium. So he wants that I should not exercise. If I don't exercise, then the premium becomes his money. So a call buyer, listen to me, I'm just completing the ask question. So call buyer has an unlimited potential of making profits, whereas a call writer has a limited potential of, the call writer has unlimited, call writer has an unlimited potential of losing money, whereas a call buyer has an unlimited potential of making money and limited potential losing money. Is that okay? A call buyer, let me explain that. A call buyer has an unlimited potential of making money because he has unlimited. So a call writer with an unlimited potential of losing money. A call buyer has a limited potential of losing money. Call buyer, he can lose only is the premium. Okay, fine. This you must know. Okay. Now, and who is going to exercise the call? The call buyer always. So in the first case, I am the call buyer. In the second case, somebody else is the call buyer. Fine. So what I do is that I, choose a strike price of 83.25. I pay a premium of 23,000. Okay. So this is the first case when I play a strategy called bull call spread. Column number I. Column number J is when I'm not playing a strategy. Okay. Where I'm just simply buying call, which I have already explained to you. Okay. Fine. Now, since I have a view which is mildly bullish, so I'm going to write a call. When I write a call, I collect a premium. Isn't it? I'll collect the premium. So I'll choose a price at a higher strike price than what I've chosen to, buy a call. I'm mildly bullish. So I think that it can go maximum to 84. Why to waste money? So up to 84, I am buying, I'm entering into the second leg, where I am writing a call and collecting a premium. Okay, the premium is 0.0425. So if I go here, 84 strike price पे जो premium है वो 0.05 है 4,250. This is the money which I am going to collect. Okay, fine. And this is the money which I am going to pay. So I can just make it this yellow also. So this is what I am paying and this is what I am collecting. Is that okay? Fine. So I come back to the screen. Now what happens is, that means the net premium which I paid is 80. I have paid 23. I have collected it now. So net premium is 18,750. Now the dollar can go here and there, anywhere. So now let's take the first scenario. It's first I'm saying theoretically. Now how does the stock exchange does it will be separate thing. Let's understand theoretically first. Stock has a different way of, I mean, cutting this. They will treat this as closed. Okay. At first, let me just go and theoretically. If I enter the two legs, then my transaction gets closed on that day, as per stock exchange. But I'll explain how. Now, suppose the rate goes to, this is the 84. Okay, fine. I have written it here. Yeah. Suppose the rate goes to 85. Suppose the rate on that day, the RBI reference rate is 85. Okay. So how much I am making money? 83 rupees 25 paisa. This one. Though I have limited myself to 84, let's say theoretically, if it goes to 85. Okay. Okay. Then what happens? I'm making a profit of, so if I use the formula here and see from where it is coming. So I'm making 1 rupee 75 paisa, which is, the difference between the thing. Is that okay? 85 minus 83. This is the money I'm making. Is that okay? Okay. So I just remove this arrow. Then at the same time, on the second leg, I'm making a loss of 1 rupee. So I just put it here. So here, 84, the second leg I played. So I'm losing money because that guy, the call buyer in the second case is going to exercise. I'm a call writer. The call buyer say, give me 1 lakh. Give me, that gain between 84 and 85. So he's going to ask me 1 rupee. So I'm going to ask 1 rupee 75 paisa and he's going to ask 1 rupee. So my net gain will remain 75,000. Is that okay? Agar, suppose it happens to close at 85. Of course, my 85, I'm not going to make money. I'm going to make only 75 rupees, 75,000, which I said here. If you look here, my difference between the two rates is 75 paisa. Okay. Look at this. The difference between the two is 75 paisa. This is the maximum money I can make, isn't it? Because I have written a call. So by writing a call, I'm limiting my potential to make unlimited money. So I can make maximum 75 paisa. How it is explained here? So I just remove it here. Suppose it happens that the dollar goes to 85. My first call is up by 2 rupees, up by 1 rupee 75 paisa, isn't it? So I will, get 1,75,000 because I'm going to exercise my call. Suppose I had played a nickel call, I would have asked for 1,75,000. Okay. Assuming I am still asking 1,75,000, but somebody is going to ask me from me 1 lakh because I have written a call also. So that call buyer is going to exercise the right and says, give me the 1 rupee difference. So my net gain will be only 75,000.
Executed at the same time.
I'm saying theoretically, it doesn't happen like this. Just to preempt that, the stock exchange will treat my, the moment I play two legs, it will close my this thing at 84. Khatam. Uske baad, I mean, so I will have booked my profit.
On your own.
Just let me just explain this. I'm not bringing that at the moment, two things. So suppose, assume this thing theoretically. So I am making 1,75,000 in the first leg. Second leg, I'm losing 1 lakh. So my net gain is 75,000. So even I make it 80, 89, till I made 75,000. I make it even the dollar goes to 100, suppose it touches the roof. Okay. Still I'm going to make 75. So my profit is not changing. In first case, I'm making 16 lakh 75,000 gain. In other case, I'm losing 16 lakhs. So because as a call buyer in the first leg, I'm exercising. I'm getting the difference. Here the difference is what? 16 rupees 70 dollars has gone to 100. So let's make it a little bit more practical. Let's make it 85. Suppose it goes to 85. So I'm going to ask 1,75,000 from the call writer, the first leg. The the other person who is a call buyer, because I've written a call, so call buyer is going to demand from me. The second person is a call buyer only, na? He's going to ask me 1 lakh rupees.
When it crosses 84, more than 84.
This is clear. Don't bring anything more further. Let's first stick to this, okay? फिर आप उसके बाद you can this thing you can play around and see whatever. Let me just complete the story. Is that okay? Fine. So your profit limited is only 75,000, isn't it? ये समझ में आ गया? कोई भी डॉलर का प्राइस पे क्लोज हो जो मैं आपको दिखा रहा हूं, अब आप अपना दिमाग घोड़ा चलाओगे कि 83 पे आएगा, वो भी आते हैं, उस पे सेकंड लगे. Now the call will be only exercised by the call buyer. In the first case, I am the call buyer. In the second case, other one is the call buyer. The call buyer is bullish guy. Okay. So if the dollar goes up, only then in that case he will exercise the right. isn't it? If the dollar goes beyond 84, then this guy is going to exercise his right. If the dollar goes beyond 83.2, I'm going to exercise the right. Okay. But if the dollar goes to somewhere below this, okay, then nobody is going to exercise the right. The call, as a call buyer, if the dollar touches say 80, for example, anything below 83.4, okay, for me, okay, then I'm going to lose money of 23,000. If the dollar closes below 83.44, I'm going to how I calculate it, then I'm not going to exercise, because this is my break-even point. The break-even point is this, where it is strike price plus premium paid minus premium received. So this becomes my break-even point. Okay. At this price, beyond this price, I'm going to exercise my call. First leg. Otherwise, I'm not going to extend my rate. So suppose that it touches at 83, below 83.44, then sure shot, I'm going to lose my premium. Okay. In the second case, the call writer, for him, the price is 83 rupees 95 paisa, because here, he has, it becomes 83. I'll just show you how. I can just show here. So this is basically this price plus the premium for him. Premium plus strike price. So he is going to stick. So he is going to, the rate is what, 84. 0.42. ये ले लिया. Okay. So it should be plus or minus. We'll just debate that. Okay. हो सकता है कि मुझे प्लस करना था, मैंने माइनस कर दिया. But anyway, क्योंकि the premium is the cost to him ना. ओके हाँ, तो ये करेगा. इसको, इसमें हमें क्या करना चाहिए था, यहां पर मुझे प्लस करना चाहिए. So beyond 84.04, he'll start exercising. Is it very clear now? So I made one mistake in the morning. So 84.0425 के बाद वो अपनी call exercise करेगा, isn't it? So if the price suppose closes, say at, let's say theoretically it closes at 83 rupees, nobody is going to exercise the call, isn't it? So in that case, in the first case, I lose the premium. In the second case, I gain the premium. So my net loss will be 18,000. So nobody at the same time, is not that, in this case, if the dollar falls below a certain threshold, then the call become worthless in both the legs. दोनों legs बेकार हो जाएंगी. पहली leg में मुझे loss हो रहा है, दूसरी leg में मुझे gain हो रहा है. So net loss is only 18,000. So maximum loss I can do is 18. So let's come back to this and then go back again. Okay. So maximum I can gain 75,000. But my net gain is how much? 56,250. Because I have paid a premium also. Na? So this was the pure gain between the dollar price difference. So if I calculate what is my net gain, it comes to 56,250. How? Look at the formula here. It is basically the gain between the difference in dollar price minus the premium. Okay. So I'm making this thing. But if I have done a naked call without entering a strategy, I would have gained only 52,000. So the strategy is giving me more money in my pocket, isn't it? Fine. Okay. So let me just close this, remove the window. Okay. So have you got it now? So let to rephrase again for all of you that in the first leg, I am a call buyer. I'll exercise the right only if the dollar goes beyond 83.44. 83.44 से ऊपर जाएगा तो ही मैं करूंगा. जैसे 83.44 है, 83.44. So suppose I make it 83.44. 83.44. So in that case, I am still making so 83.44 आ गया. So I have actually written a call at 84. Okay, the dollar has come down to 83. Okay, so in this case, this figure should become zero ideally. So I'm gaining only 19,000. Is it okay? So let's not complicate it. So let's bring it back again. So 75,000 is the maximum profit I can make. Okay, if that was the case only when I have not would have written a written call, that example. Okay, so here I am, let me come back again. So there is a call buyer. The first case, I am a call buyer. I will exercise my right only if the dollar breaches 83.44. Okay, fine. Before that, I'm not going to exercise my call. Okay. And in the second leg, the call, I'm a call writer. So the call buyer is again a bullish guy. So he has actually, accepted 84 as the price at which I'm willing to buy dollar. He is willing to buy dollar from me, 84. Okay. If the dollar goes to 83, he's not going to exercise his right. Why would he, pay me 84 for something which is costing 83? तो 84 में तो वो एक्सरसाइज करेगा ही नहीं. 84 से ऊपर जाएगा तब वो एक्सरसाइज करेगा ना अपना. Because if the price touches 82, 81, he's not going to exercise because why? He will, he has written a call option to buy the dollars from me at 84. When they are available at 82 in the market, why is he going to buy it from 84? He's going to let it expire worthless, isn't it? So in these options, what will happen is if the rate falls below a certain level, both the legs will expire worthless. So the maximum loss which can happen to me is the difference between the two premium. Is that okay? Fine. So this call will give me maximum gain of 75 paisa. Okay. And net gain of 75,000 rupees in my net gain minus the option premium. Okay. So 56,000 and maximum loss I can suffer is 18,000. In this case, maximum loss will be 23,000. Now, let's look at the two this thing. Suppose I would have played a strategy. So my maximum loss would have been, if dollar would have touched 80, I would have lost 18,000. But if I have not played the second leg, then my maximum loss could have gone to 23,000, isn't it? So you're restricting your profits, you're restricting your losses also. Because you have a mild view on dollar. Dollar is not going to go run away. So let me just, bring down my cost of hedging. So basically, I want to bring down my cost of hedging, isn't it? Because the premium is generally higher. So I say, okay, let me just bring down my cost of hedging. But what I am sacrificing? The potential profit which I am going to make. So that is the clear message. Don't read it beyond. Baki up Excel mein, you can just put any number and just play around what you want. Have you got it? Okay, let's go to now bear put spread here. As an exporter, let's understand. What would happen is that when you are looking at a call option, there you are buying, that the dollar goes at a certain price, then you will exercise it. Put option is just like walking at the back. आप पीछे चल रहे हो तो उसमें आपको टेंशन ज्यादा होती है and there is more pressure in your mind. So when you're short selling, sometimes it's difficult to understand because it's just like liking walking. I mean, not in front, but walking at the back, but just using खड़े होके आगे खड़े होकर पीछे चल रहे हो, वो वाली चीज होती है वही. Okay, let's say here now you buy a put option. When you buy a put option, what is your position? Bullish or bearish?
I'm a bearish.
Bearish guy. You want the dollar will go down. Okay, you expect the dollar to depreciate. You don't want dollar to appreciate. अगर आपको डॉलर एप्रिशिएट होता तो आपने हेजिंग नहीं कराते अगर आप एक्सपोर्टर हैं तो. But let's say that you're neither exporter or importer, but if you are just buying a put, you're expecting the dollar to go down. That is your view. The dollar is going to, Indian rupee is going to appreciate against the dollar. That is your view. So you bought a put at 83 and you paid a premium of 0.020. So let's say put option here. So 83 is the strike price and 0.02 is the premium. Okay. So this was, when you bought a put, you are put buyer. You choose a strike price of 83 and you paid a premium of 0.20. Okay. So you put this number here, these two numbers here from there. Then now you know that the dollar will go down not so much. You are mildly bearish, not extremely bearish. You think it can go down to 82. So today I am paying a premium of 20,000. Assume that you are just a speculator. तो आपने 20,000 रुपए दे दिए. आप चाहते हो थोड़ा बच जाए मेरा, क्योंकि डॉलर विल नॉट ब्रीच 82. गिरेगा तो कितना गिरेगा? 1 रुपए गिर जाएगा ऐसा. So what I am going to do, I am going to write a put, and I am going to collect this much of premium, 3,500. If you look at a put option here, so here 82 strike price, the premium is 0.35. So I am paying a premium of 3,500. Okay. So let's go back. So here I am collecting a premium. Okay. So 20,000, 3,500 collected. So my net premium paid is 17,000, isn't it? Okay. Now, if the dollar goes down by 1 rupee, I'm making 1 rupee of profit. Okay, let's first, then we go down to this thing. So I made 1 lakh rupees of profit. The second, if I would have not played this strategy, I would have made the same amount of profit. But the premium was, in this case, was 17,000. In this case, it was 20,000. So my profit here would be 83,000. In this case, it will be 79,000. So strategy has helped me. Okay, maximum loss would have been 17,000. That is the difference between the two premium. This is 20,000. So if I check the formula, so this is the formula is coming from here only. This is the difference between the two. Is that okay? 20,500 minus 3,500. So this was the premium. Maximum loss would be this. But in case I would have played only the no strategy, I would have lost maximum was 20,500. Isn't okay? Fine. Now let's understand. As a put buyer, I'm bearish, isn't it? I'll exercise the right when the dollar reaches to as falls compared to the rupee. Fine. It falls, more it falls, better for me. Suppose, assume it falls to 81. 81. I would have made a 2 rupees gain. If I would not play the strategy, I have collected 2 lakh. But since the other guy who has bought a put from me, I have written a put, he has bought. He's going to also, he's also going to, exercise his right. So he's going to collect 1 rupee from me. So he's going to collect. So net gain will be only 1 lakh. Okay, fine. Now, what happens is the stock exchange, the moment I enter into this trade, the stock exchange will understand that, and there will be no give and take of like this happening on the expiry. Okay, net gain आपको 1 लाख रुपए मिल जाएगा, बस खत्म. Fine, and that we'll understand little later what are the mechanics. Okay, but the positions are closed as soon as I take one position and other opposite position. Stock exchange will recognize I've taken two positions which are opposite to each other. They'll close. Okay, fine, and there'll be no further margin collected from the guys from where the margin has to be collected because the position stands closed. Okay, we'll understand more when we go to this. हाँ, अगर कोई margin है, the call writer has to pay the margin. Put writer has to pay the margin because they have unlimited potential of making losses. So the stock has to make sure that eventually, if there is a good amount of loss, the amount should have already been collected by the stock exchange as a margin. Now just hold on to it. मेरे को आगे extra अब मैं भूल ना जाऊँ. Sorry, अब अपना question करना. The moment I write this call, okay, the moment I write this call, now I am a call writer. Margins apply to me, but I don't have to pay any margin because I have a long put and a short put. So the margins will not be required because already I have closed my position from the stock. Why should the stock exchange collect from margin from me? See, what happens is because the subsequent settlement doesn't happen. The subsequent means the call. In the second case, I am a call writer. Second leg, there is a call buyer also. So he is not entitled to exercise right because I have See, the margin जो है देखो call. If I am a call writer, suppose I was just a call writer, okay, then I have an unlimited potential of losing money. Okay, I have no other position, so the stock exchange is going to. I can lose a lakh rupees. I can lose 2 lakh rupees. Okay, so stock exchange is going to collect margin from me. Okay, like in futures, वैसे margin collect होगा मेरे account से. Yeah, options में भी collect होगा. Call writers, either a call writer or put writer, because call writer and put writers can lose any amount of money. Okay, so the margin needs to be collected from this. Premium. So buyer can maximum lose the premium. उन्होंने तो premium दे दिया, उसका maximum loss वही हो सकता था. They tend to gain only, not lose anything. So why should they pay a margin?
In case of call writer and put writer,
They have to pay a margin.
There would be outflow of premium minus a margin.
नहीं,
Inflow of premium minus
हाँ,
a margin.
premium तो उनको मिल जाएगा. That will be their money income in case they pocketed. So that will be given to them. And the second would be that some margin they have to pay, and which will be refunded to them. If suppose it goes in favor, all the margin will come to them. Okay.
It's a security money.
Yeah, security, because stock. No, this is there. Margin needs to be correct. Now tell me. Suppose the call writer loses a 3 lakh rupees. How the stock exchange is going to settle it? If they ask call writer to pay 3 lakh at the expiry. He is, I don't have money.
Okay, okay.
So there's a mark-to-market settlement happening. There is a margin. There is a margin and mark-to-market settlement. Both will apply to the call writer and a port writer. End of the day, money will be collected. Fine. Margin के अलावा daily up and down का पैसा भी उसको देना लेना.
He is under obligation. He has to ensure that he will be.
So that on the expiry day there is only a there's nothing to be collected. So that's why they are offering a foolproof transaction closure.
Otherwise, he can back out.
He can back out. So the stock exchange makes it absolutely different. Okay. So now, what's the time? Is it break time?